You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means it is time once again for Options Playbook Radio, the program where we break down the offensive and defensive plays that you can utilize in your own trading portfolios. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the Options Insider Radio Network. Let me be first to say Happy New Year to all of you out there listening to this fine program. Hope you celebrated well and fun and responsibly, and that you're enjoying this fine episode here. Perhaps taking in some bowl games, perhaps enjoying a little bit of the hair of the dog that bit you, whatever it is that gets you started in the new year. Also probably busy writing down your New Year's resolutions. Hopefully it's to consume a lot more options content because we got some in store for you here. And also joining me on the old program, your usual host, your go-to, a.k.a. the options guy, Mr. Brian Overby, the senior options analyst over there at Ally Invest. Brian, welcome back to your own program, and Happy New Year to you, sir.
Well, thank you so much, Mark, and I always love it when you host. And as promised last week, we're going to come back and we're going to answer some more of these questions. Man, they're just piling up in the inbox. So we're going to take this time to huddle up and welcome you into 2020.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody, welcome to the huddle. You know the drill by now. This is where you guys take over the episode. The inmates run the asylum, and we have all sorts of fun as a result. Brian, can you believe we're entering our second decade of Options Playbook Radio madness, sir? What do you think?
Wow, that's crazy. That's just crazy. That's almost deniable. I can't even believe it.
Exactly. Second decade of Options Playbook Radio. What better way to kick it off than with you guys taking the reins here? First off, this one, Brian, is an interesting one. It comes from PL Form. Let's just go with PL Form. Asking a question a lot of people have had on the brain. They've written in, others have written into other shows in the network about this exact topic. Clearly, this Bloomberg article got a lot of people thinking and maybe scratching their chins. I know this is an area of the space that is near and dear, perhaps not so much to you over there, but PL Form writes, hey back at you. Says, what does Brian think about the potential return of short volatility products like the one listed below? And he includes a link to the recent Bloomberg article that has been raising a lot of hackles out there in the space, called The Ghost of XIV Rises. New short vol products in the pipeline. If you missed it, listeners, effectively the article breaks down a new startup, which is kind of interesting. Usually you don't see these types of products from startups. You see them from large, established financial institutions like ran XIV previously until it all melted down. They're saying that this new product, which I believe is going to be called SVIX, I believe is the ticker here. Yes, SVIX. They say it should perform better in those types of stress scenarios, only lose 30% as opposed to complete wipeout for that XIV suffered. Also, that they plan to have it rebalanced throughout the day continuously rather than once, at the end of the day. So all these things are designed to potentially, hopefully, shield it from some of the issues that occurred with XIV. Obviously, just anecdotally from looking at all the number of you guys who have written in about this article, clearly there's some demand for a product like this. The question arises, obviously, as PL Form asks here, does this have legs to it? I'm not familiar with this firm. I'm not familiar with any of these people who are creating it. Again, this thing's seem like it's progressing. I'll make sure we reach out to them on the network, maybe get them on Volviews to pick their brains a little bit right now. But I'm always, shall we say, concerned when a startup is trying to tread in waters that a large financial institution had a hard time having the capital and really the backing to manage effectively. But that said, there clearly is a demand for something in this space. So I don't think, if this doesn't work, I don't think this is going to be the last tilt of the windmill that we see out here. Other players are going to come because people clearly like this. Brian, I know this has kind of been a bit of a mixed bag for you in the past, this whole short volatility space. Obviously, the way XIV imploded wasn't good for anyone. But I'm curious, A, if you saw this article, and then B, if you did, PL Form wants to know, what do you think about the return of maybe not this product in and of itself, but this entire category of these effectively short volatility type products?
Well, I'm going to sum it up quickly. Yes, I did see it, but he drew my attention to it, so I have read the bullet points around it and the concept of it. And I think one phrase that I've used many times when we've answered listener questions is just lay down until the urge goes away. I would really like to see these products just go away. I understand that there's demand for it because people think, if you look at it, if the VIX goes to 50, it's going to come back down to 20, right? We all know that it's going to do that. So that's why that demand is there. How can I take advantage of it when it happens? I want to be able to do it. The bottom line is the products just aren't going to warrant that. Everybody in the world knows that when the VIX gets to 50, it's going to come back down to 20 at some point in time of its life. We're just going to hand money to everybody that knows that and wants to try to make money from it. So here's my thing. If it works, it will work for a while. It will maybe prosper for a little bit over time, but eventually the product's just going to break down. I don't know how it can exist and allow people to take these type of advantages in these short indexes and actually match the actual VIX index and the movement of the VIX index and how it trades. So now you're just trading some arbitrage volatility number that's really not based on anything. And so you might as well just call it the baseless volatility index, because that's eventually that. So a fairly strong opinion. I dealt with a lot of clients that really got cremated by the VIX, and it's just I hated to see it happen. I don't want to see it happen again, and these products should just be outlawed. It's just that simple.
Yeah, it's obviously a contentious area of the space. I'm kind of with you in the sense I don't know if this is the one. Clearly, they're going to keep trying it. I don't know if this is the one that's going to break through and actually get approved. I haven't really heard from the regulators that there's much demand or desire on their part to really see this product space come back. That's obviously a clear stumbling block. I don't know if this startup has the regulatory muscle and capital to make that happen. That's a big question. We saw recently with our friends over there at MIAX, a regulated exchange group, listing a volatility product that was just a straight, pretty much one-to-one volatility product, no inverse, nothing like that. And they had to take it off the market a few days after because of some regulatory questions. So these regulatory issues around all these volatility products are intense, and the scrutiny is intense. Whether this startup can weather that and also make a product that will pass regulatory muster is a huge, huge open question that I'm not convinced they are there yet. Good for them for getting some ink in Bloomberg and getting some attention to this, but I don't know if we're quite there yet. And then once it lists, Brian's right, there are a number of inevitable issues that are going to arise with this product, and it'll be interesting to see how, if this thing is approved and listed, how this thing weathers that storm. Regardless, when one of these products comes back, I think it's a when rather than an if. When one of these products is listed again, I think the industry has to do a much better job of gating these things. People realize they're not just buying SPY, they're buying something that has a whole host of inherent risks to it, and really making that very clear. People have proposed in the past maybe putting levels of approval on these things like you have for options now. You have to be 1, 2, or 3 to do certain option strategies. Maybe for more sophisticated ETPs, you should have a level 1, level 2, level 3. In fact, I actually put that to Hester Peirce of the SEC not too long ago. She didn't seem too receptive to that idea, but that idea has been floated around out there in the past. Maybe if this comes back, maybe that's something we'll see to attempt to minimize what Brian was referring to, which is just the wreckage that XIV left in its wake. And I too saw a lot of people reach out to us, obviously, here about XIV who were left holding the bag, who clearly never should have been in that product. Someone should have stepped in along the way, whether it was the broker, whether it was an educator, whether it was the industry, whether it was somebody, and said, hey, proverbial grandmother from Iowa, and trust me, that isn't too far off from the people who are reaching out to us, you should never have owned XIV in your retirement account. It doesn't make sense. So, yeah, there were a lot of failures along the way, and I think a lot of these have to be addressed before something like SVIX or whatever the inevitable thing that comes along can take its place and really get out there in the marketplace again. All right, next up, we've got Ian Mack. A lot of questions about articles these days, Brian. Ian Mack wants to know, do you see a lot of this type of information leakage playing out in the options market? He includes a link to, I believe this is an article from the Journal called Wall Street is Being Hunted by Futures Cops for Government Leaks. And this article refers back to a big story that was back a few months ago, which we kind of poo-pooed on the network a little bit, about Vanity Fair, of all places, trying to break some news about people in the government allegedly using futures markets and getting ahead of key government numbers. When we poo-pooed that, I want to clarify, we're not poo-pooing the notion of information leakage. I have an interesting story about that as well, which I'll share in a little bit. I think that stuff does get out there, but I think that particular story has kind of been since proved to be pretty much false. I don't think anyone really turns to. If you have a hot tip, are you going to call up Vanity Fair to leak it on the markets? Probably not. But that said, the notion in and of itself, like our listener here, what was the name? Ian Mack, it does maybe have some credence. Brian, what are your thoughts in general about the notion of some of this government data, some of these government developments leaking out into the marketplace? And do you see any reflections of that in the options market, sir?
Well, if it's happening, it's above my pay grade, right? In that if there were this type of action, I don't go looking for it personally. I just kind of, as far as my trading is concerned, I think it would be absolutely horrible. I haven't really put a lot of thought into it. I actually haven't read this one particular article about this, but if this is happening, I haven't necessarily seen it, but you're right, that would be the marketplace that it would be in. It would be in the futures market. First of all, they're extremely liquid markets, and they trade, ungodly hours of the day. But I don't know. Do you have? Mark, you're more on top of these type of things like this, just because you get so many listener questions bringing it at you.
I guess I'm story guy today in the last couple of shows because I got another one for this one. I happen to have weirdly appropriate stories for all of these. But yes, I do have a good example because this information does leak out. Let's just say Washington is a bit of a sieve, and the options market is where a lot of not just government data, but insider, all this kind of stuff is usually reflected in the options market because it's a very short-term, usually type of instrument. You can get a lot of leverage, a lot of bang for your buck. If you know something's going to happen pretty soon in a stock or in something else, chances are you're going to go to the options market to express that view because you get more bang for your buck. And also the regulatory oversight, let's say, has been a little bit less than it is in the underlying equity. It's harder to prove XYZ company knew or customer knew this when he made that trade and vice versa. It's improved light years since I first came into this business. But that said, I do have a good story. One of the worst examples, Brian, I ever encountered of not just actually I dodged this one ironically, but an entire pit being effectively almost wiped out came from something like this. It was back in the late 90s. I was fairly new in the SPX. I had just broken into kind of the back corner of the pit. The pit's much larger now than it was. And all of a sudden, the phones start ringing off the hook. It's like kind of an early, quiet morning, probably like a half an hour into the day, maybe a little early, I forgot. Not much going on. And all of a sudden, this broker's all throughout the pit listings. All of a sudden, one by one, every broker's phone starts lighting up. Bam, bam, bam. They're all picking up the phone. Hello? Say something. Next thing you know, they're all calling for puts. This guy wants this at the money put. This guy wants this at the money put. This guy wants that at the money put. And they're just calling out markets. So everyone's giving them markets. And then the next thing you know, this all happens obviously in the span of a couple of seconds, listeners, because things happen pretty quick down there. Next thing you know, every one of these brokers is lifting the offer or maybe sometimes even paying through them to get done. And that immediately, I was still pretty new. So I was like, what is going on? I'd never seen anything like this before. And all of a sudden, when every broker, including the guy standing right next to me, is lifting offers, doesn't happen very often. So everyone is fighting, trampling each other to get out, say sold, say sold, say sold. I'll sell 50, I'll sell 100, I'll sell 200, however many you can get off. And so what do you do, listeners, of course, when, that moment, it was one of those things that just seemed strange to me. And so it gave me a moment's hesitation. And that moment was enough. Because I watch some of these guys around me get filled, selling 100, sell 200. What do you do, listeners? If you're a market maker, you trade usually delta neutral. You sell your puts, you turn around to sell your SPUs, your S&P futures, against it to hedge it. Guess what happened in the moment that between when they said sold to the broker and the broker said okay, to turn around to their S&P futures broker and say sell however many, sell 10, sell 20, sell 50 futures against it, whatever the case may be. Guess what? The futures weren't where they were anymore. There were many handles lower. I forgot exactly how many they dropped. Probably at least 10, if not more. And if you know anything about S&P futures, missing your futures for many handles, that's going to leave a mark. And pretty much instantaneously around me, all the guys around me were down many, many hundreds of thousands of dollars. Some of the large groups with other guys, they were down many more, into the millions. And it was just a wipeout across the board. And just for that, because I happened to have that one moment of pause to say, I wonder if this is right. That happened to save me from going over that same cliff with the rest of them. And it turned out a few minutes later, the news broke that Robert Rubin was resigning as Treasury Secretary at that time. So clearly, that is a demonstrable example of huge, enormous information leakage, because that was well before it hit the tape that these phones started lighting up. So that's one I happened to be personally witness to, and thankfully, but for a little bit of hesitation, would have been subject to myself. Obviously, this is a little bit ago. Markets have changed a little bit since then, but that type of information does still get out there. Look, you have people who are staffers. They report to other staffers and other things out there. There's been many studies out there in the past that say senators are some of the best insider traders on the planet when it comes to stock picking and everything else like that. How do you think that is? So this information does get out there, and it is expressed in the options marketplace. Options are not immune to that. What do you think of that, Mr. Bryan? I narrowly avoided disaster, and all because of Mr. Robert Rubin, sir.
Well, that was a fun story. I enjoyed it. And yes, senators are there. It's been definitely proven, and that is one thing that I've also heard about. And because when something gets announced on the floor of the Senate or of the House, that is considered public information. But it hasn't been announced across the world. And so, yeah, it is public, but nobody, unless you're watching C-SPAN 24/7, you're not going to be privy to that news. So, yeah, that, without a doubt. And they're not supposed to take advantage of it, but they still do. And there hasn't been great laws passed to try to fix that problem. There's no doubt about that.
C-SPAN, the new economic indicator. Who knew? You got to watch C-SPAN for all your hot tips. All right, let's end on something. It's a new year, new decade. Let's end on something a little bit more fun, a little more option-centric, a little more optimistic here. This comes from Nichols. Nichols wants to know, why is an options price called premium? Why is it selling premium when I sell an option? Well, Mr. Bryan, regale Mr. or Mrs. Nichols. Why the heck do we call it premium, sir?
Well, yeah, I enjoy answering this question, actually, because, the options marketplace, and this is always how I start basic option seminars, is you shouldn't start by just learning a strategy, and as simple a strategy as you say, buy a call, buy a put because you're bullish or you're bearish. You should learn about option pricing, and options really came from a need to insure things. It could be corn, Dutch tulip bulbs, if you want to go way back to the 16th century. There's been a lot of different uses of options out there, but where they've all evolved from is protection, from hedging, from insuring the marketplace. So when you sell an option contract, another term that is used quite often is rider. Where does that come from? The insurance world. If you think about car insurance salesman, you're going to say, okay, I got your information. Now let me bring it to the underwriters of the policy to try to get a quote. So when you're selling option contracts, you're considered the writer of that contract, and hence, if you're thinking of it as where they really came from, not a need to speculate, but a need to protect, If you think of it that way, well, then what would you call the price of that? You would call it the premium, just like you pay your car insurance premium. As a matter of fact, a lot of the models that you hear about option pricing models, well, they're really some modification of a lot of the insurance pricing models. They're not that dissimilar than those. A lot of the same variables are in there, and they use actuarial, like one of the biggest well-paid positions in the world is an actuarial scientist, which is just basically a statistician that figures out the potential of this specific profile actually getting in an accident. And that's the same thing that we're talking about when you're looking at option prices. You're looking at what's the probability of this stock reaching this strike before that expiration. And the risk factor that we call that implied volatility. In the insurance world, they just call it risk. So there are a lot of similarities between the insurance world, and I actually think that if you're a beginning option trader, this is where you should start. You should learn why are options priced the way they are relative to the stock before you ever think about just buying an option contract outright.
Well said, sir. Yeah, the options world is littered with arcane terminology. Sometimes we use them so often and so frequently we forget to step back and maybe define them. People who are new and coming into all these things, rider, premium, of course, premium. It's actually, there's a lot going on in there. Obviously, there's intrinsic and extrinsic value, and obviously you should check out Brian's book. It breaks down all that good stuff and a lot more. But premium, this goes back to the early days of on the floor of the sea when people used to just sell options all day, and they were selling effectively the extrinsic value that's going to decay to zero. So they viewed it as extra. It was extra value. It was premium. I think that's kind of how that was the genesis of that term way back in the primordial ooze day, and it's kind of just stuck. It's stuck ever since. It's like names like front spread and back spread, the origins of which are lost in the sands of time over there. So a lot of these fun terms lingering around the option space. Maybe we need to do a whole terminology episode one of these days, just defining some things for our listeners out there. Unfortunately, that won't be today, Brian, because we have run out of time. But if folks want to participate on future huddles, they want to reach out to you with ideas or questions for future episodes of Options Playbook Radio. Now they're kicking off a new decade, Brian. Where should they go? What should they do?
Well, obviously, you can always email me directly, and my email address that's set up specifically for the show is theoptionsguy@invest.ally.com. Now, remember, that's options with an S, theoptionsguy@invest.ally.com. And thanks for listening. Thanks for you hosting, Mark, bringing us into the 2020 year. And we will have a lot of great shows going forward. So thanks for all the support from everybody out there, and we'll talk to you soon.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.